Some breaking news crossing the Bloomberg terminal, this time around the British oil giant BP. They're selling their interests when it comes to the Permian and their Eagle Ford assets over in the United States. Some of the onshore assets totaling to about $1.5 billion. This is crucial for a couple of reasons here. One, BP is kind of on a journey to divest. They really have to deal with a lot of their bondholders, a maturity wall coming up in 2027 that they're trying to deal with. So this is something that's been on their radar and an option they've been considering for some time. Here's what piqued my interest. They're selling those onshore assets to the private investor Sixth Street. It's really fascinating to see a private market player actually get their hands on oil interests, specifically in the Permian, where, of course, in the States, the domestic story guy is consolidation specifically for the Permian. And that, of course, has just been getting the green light when it comes to the likes of the DOJ. So BP getting out of a place where a lot of people want to get into.
BP's got its numbers out tomorrow. Why is it doing this today? What is that maybe tell us about the earnings? I don't know. Maybe I'm drawing too many dots.
Do it. Get that magnifying glass out.
I don't know. It's going to make the earnings a little bit more exciting. Are they going to return money to shareholders? What are they going to do with that cash? OK, let's talk about what we've got this Monday morning. It is the 3rd of November. We are starting a new month. It feels like it's risk on this morning, only just, as you can see by the futures that you've got in front of you at the moment. Bilal Hafeez says here, head of market strategy at Macro Hive. Is that still correct?
That's still correct, yeah. Well, Macro recently got acquired by BGC, so I'm not quite sure what my title is now.
We'll look forward to the next appearance and we'll find out. Markets risk on this Monday morning. Is that the right trade going into the new month?
I think it is. I think, we've had some really good news on the US-China news on the trade side. On top of that, the market got very excited about the possibility of the Fed not moving in December, and I think all the news in the next couple of weeks will be that they will likely cut in December. So all of that together...
and the AI trade is on, is it? This is the juggernaut that just keeps everything rolling forward, that keeps equities trundling higher.
Yeah, I think for now it all sort of continues. A big part of it is obviously the CapEx trade that the AI companies are doing, and as long as they keep committing to it, it's one of those cases of the more CapEx they do, the more demand it implies to some extent, and then the markets...
Where's the risk in that? Because the reaction to Meta was kind of interesting. You got a sort of differentiated reaction last week, which was interesting. Meta's coming to the market, they're spending big, they're issuing debt now to try and finance this, like where that shows up on the balance sheet, or if at all, I don't know. But you got a kind of negative reaction. So the market's becoming a little bit more nuanced in terms of its approach to whether or not different companies will be able to deliver from this gargantuan spend.
Yeah, I think if you look at the market reaction, I think the companies that have a broader offering in terms of how people can use the data centers are the ones that are benefiting the most. The ones that have a cloud business have a very sort of clear AI strategy in terms of services that external customers can use. Those are the ones that are benefiting the most. So if you have a cloud offering, you can use data centers for that as well, whereas some companies aren't able to offer that.
Bilal, you said you're encouraged by the Fed. Are you just ignoring Jay Powell's hawkishness then?
Pretty much at the moment. So, at the moment, the markets at least are still expecting a December cut. I think on balance, if you look at the labour market data, we get some data later on this week, shows that, payroll growth is very likely to be close to zero on average over the last 3-4 months. Powell did talk about inflation risks, but I do think that the labour market is really what they have been talking about, and I think that will be what they'll continue to talk about. So I think he just tried to introduce some two-way risk. There is some uncertainty around, how the votes will go in December, so that's a new risk that we have to contend with. But I think on balance, cut is still on.
Makes you wonder what happens if they don't cut.
Well, yeah. You've had various bits of Fed speak kind of pushing back against the cuts, right, over the past week. But, if you look at all the talk of Sell America, right, if you look at dollar assets into Q4, pretty resilient. OK, so I just want to know, is debasement over?
I think that debasement is still on. I think right now we're in this corrective mode within the overall debasement theme, because I think in the end the Fed will eventually end up cutting rates a lot more than people think. And part of that reason is I think the Fed cares a lot more in the end about labour market than it cares about inflation, unlike many other countries around the world. On top of that, I do think that you have to take into account that Powell will be leaving next year as well. So we have a change in the whole leadership of the Fed at a time where there's much more influence by the administration on who you will take on that role. So that, feeds into the debasement trade.
Well, where is the bond market taking its cue from? To go, I mean, we talked about debasement with Lizzie. Guy made the point around the Meta earnings piece where the stock market didn't receive it well, but the bond market definitely did with their gigantic issuance being oversubscribed. Where are credit markets broadly taking their cue from?
It's a good question. I mean, I think there's a couple of different sort of cues. You know, one is I think credit in general will do well as long as we don't have a recession. You know, so I think that it's all about the tail risk more than anything else with credit. And for now, it seems like, you know, with the scale of capex that's, you know, in play here, a recession is unlikely. And even though there is a deterioration in the labour market, it doesn't seem like we're going to have a spike in the unemployment rate. So I think that, number one, tells you that credit market will be well supported. Then on top of that, the Fed did reverse its QT program. So I think it tells you that the Fed ultimately will be there to stabilise markets if needed. So I think credit is taking cues from those sides.
Can we just talk about the long end of the curve for a moment? We've been talking a lot on this show, and of course, I think broadly, everyone's been a little bit worried about the cracks in private credit specifically. What's really confusing to me about this is that we're concerned about the private credit markets. We're concerned about these long duration assets. And yet, it's not creating any sort of changes or bids in the long end of the curve, in the long end of really any asset that requires a 10 or 30-year time horizon. Where is the cross-asset correlation for something like that? And I bring this up in the context of when we were talking about private credit in the context of some of the endowments in the United States liquidating their positions, there was an active move into the long end of the U.S. curve as a way to get that duration exposure. We're not seeing that this time around.
No. Well, I mean, we're not seeing as much of it from the flow data, but certainly if you look at the curve in general, so 5s, 30s, or any sort of measure of the curve is flatter than you would have thought, given the size of the U.S. deficit, given inflation concerns. So that tells you somebody is buying the long end at a price that doesn't seem to reflect fundamentals. So it could be endowments, could be other asset allocators. So I think there is still some some non-economic demand, you could say.
Is that related to the private credit story, or is that its own separate thing?
I think it is related to private credit insofar as since the global financial crisis, there's been two biggest balance sheet growth items in the U.S. One is private credit or private markets in general, and credit being a subcomponent of that, and the other has been sovereign debt. So you would expect that both should get repriced significantly lower, and you're not seeing that on the sovereign side. Buffett
is selling. Cash pile's enormous. He's not even buying back his own stock. Should that worry you? Are we in a position right now where you want to be protecting the gains you've had over the last few years, or thinking about the future gains to come? I was talking to Sergio Motti last week. It's interesting. UBS clients are starting to get a little bit more defensive. I'm just kind of anecdotally, you're starting to hear some of the biggest names going, just be careful here. Should we be careful here?
I think one should always be careful, but at the same time, you know, we have had some really quite good news recently in terms of the de-escalation of US-China. I also think in terms of the AI capex story, I think that probably has further to run insofar as, you know, we're at the early stages of this type of build, and I think it's very tempting to compare it to the dot-com period, but there's some key differences. So I think this hesitation and this talk about bubbles right now, to me, suggests that, you know, it probably has further legs to run. It hasn't become as strong a consensus.
So you want to still be all in?
I would want to. Obviously, you want to do it in a prudent fashion, but I wouldn't want to go short equities at these sorts of levels.
Bilal, can we talk about the UK budget? Gilt's had an unusually good, surprisingly good October. If Rachel Reeves, the Chancellor, goes hard and when it comes to taxing the rich and really grows this headroom, is the gilt market going to be doing cartwheels?
I think that if she does something, you know, tax hike, I mean, we're already seeing it. Gilts like it. You know, so in general, I think the more aggressive she is, you know, whether she taxes the rich, whether she raises the basic income tax, or whatever she does, if it's anything close to what people are expecting, then gilts will like that trade as a whole. Whether individuals will like that, whether people in the city will like that is another question. But I think the market is really looking for something on the austerity side, higher taxes, cutting spending, and anything that's the opposite of what previous administrations have done.
Are we going to do this every weekend now? It's just going to be the weekend papers full of...
Every Monday morning.
Every Monday morning you'll be here with your news on tax rises.
Yeah, but isn't it a misinterpretation? The market wants austerity, but the Labour Party wants taxing the rich. Ultimately, she needs to make more headroom, and maybe this could be a hit to growth by losing it in translation.
Yeah. I mean, I think in the short run, it will take time for it to have that sort of hit to growth. So in the short term, the question is, does she care more about the gilt market or does she care more about growth? And the growth angle, already the OBRs reduce productivity, and then there's this. Yeah. How do you increase productivity? That's a long-term supply side issue. So I think she's going to have to contend with different priorities, and gilts will be her bigger priority right now.
Bilal Hafeez, head of market strategy over at Macro Hive, talking to us a little bit about everything. Coming up, we continue the conversation on the bond market. We're going to talk about the story on both sides of the Atlantic. Vishal Kanduja from Morgan Stanley joins us next. This is Bloomberg.
Oh, so you corporate